Welcome to the Deep Dive. We're the show that digs into some really complex, sometimes dense source material, and, well, we try to pull out the essential insights you need. And today, we're tackling one of those big investment questions, the kind that trips up almost everyone at some point. Should you spread your money wide, like just buying an S&P 500 index fund? Or should you go deep? Pick just a few stocks you've researched like crazy. It feels like completely opposite advice, doesn't it? How could both possibly work? Okay, let's unpack this. So, our main source for this deep dive is this really fascinating, and I'll admit, pretty technical paper. It's called Indices of Quadratic Programs Over Reproducing Kernel Hilbert Spaces for Fun and Profit. It's by Geoffrey Houdinette and J.E. Pascoe. Now, yeah, that title sounds intense, but stick with us. Our mission here is to really pull out the core ideas from this mathematical work and sort of bridge that gap between the abstract math and, well, real-world finance. And even organizational strategy, surprisingly.
Ultimately, we want to help you understand how these two seemingly conflicting investment ideas might actually connect in a really deep way, maybe even point to some kind of hidden truth about how markets work.
That's a great way to put it, because when most people think market, they think S&P 500, Dow Jones, NASDAQ, right? These indices, they're designed to be snapshots, like gauges of market health. And that leads straight into one of the big philosophies, the Bogleheads, followers of Jack Bogle from Vanguard. Their whole thing is basically you just can't reliably beat a broad index like the S&P 500 over the long run, full stop. The thinking behind it is pretty profound, actually. It's like a broad index sort of mirrors how society allocates its resources, its productive capacity, and you can't really fundamentally outpace the real growth of society consistently within the market itself. It's tied into ideas like the efficient market hypothesis, the idea that prices already reflect all the known information.
Right, the efficient market idea. So trying to outsmart it is, well, mostly futile in that view.
Exactly. But then you have the complete opposite camp, the value investors. Think Benjamin Graham, Warren Buffett. Their approach is totally different. It's about making a very narrow range of extremely well-researched long investments. And long here is key. It means actually owning the thing, the company, the asset, not playing with shorts or options or complex derivatives. It's about ownership. They're looking for determinism. They want predictability in cash flows, in value, even if the market price bounces around. It's the opposite of speculating on, say, growth stocks that might have huge potential, but maybe no profit right now.
So one side says own the haystack, the other says find the needle.
Pretty much. And what's fascinating here, and this is where the paper comes in, is that it actually offers a formal mathematical way to think about why both lines of reasoning might have merit. It introduces this idea they call the invisible index theorem.
Okay, invisible index theorem. That sounds intriguing.
It is. It suggests that maybe these opposing strategies, broad indexing and focused value investing, are actually, in a way, both trying to approximate the same underlying, maybe hidden, optimal market index. The math suggests optimal portfolios tend to be sparse, meaning few assets, but they still approximate this broader, almost platonic index. So it's where things get really interesting mathematically.
That is fascinating. So our intuition about investing, maybe chasing high returns, can lead us astray if we ignore the underlying math.
Precisely. The paper gives a really solid justification for why diversification isn't just like a nice suggestion. It's mathematically fundamental. They connect it to something called the arithmetic geometric mean inequality, which basically boils down to parallel beats sequential.
Parallel beats sequential. Okay, let's make that concrete. You mentioned coin games earlier.
Yeah, exactly. Let's play a couple.
All right, game one, the one coin game. Simple rules. You bet any amount you want. If you win the flip, you double your bet. Bet $1, get 2 back. Great. But if you lose, you only get 2/5, 40% of your bet back. And let's say we round down pennies. 50-50 chance, heads or tails. So first thought, average return looks good, right? 2 plus 0.4, 2 goes 1.2. So on average, you make 20% per flip. Sounds like a money machine.
It sounds amazing, doesn't it? But this is where our intuition about averages fails us with compounding risk. Let's try the go all in strategy. Bet everything every time. Let's say we get a slightly unlucky but totally possible sequence. HTETTTTT 10 flips. Start with $1. Flip 1, heads, win, won $2. Flip 2, tails, lose. $2 is made at 80 cents, 25th. Flip 3, tails, lose again, $1.87. Flip 4, tails, lose, $1.32, $1.12, rounding down. Flip 5, tails, lose, $1.12 and 4 cents. Flip 6, tails, lose, so $4.01. Uh-oh. Flip 7, heads, win, $8 and 2 tails. Flip 8, heads, win, $0.02 or $1.04. Win, $0.04 or $8. Lose, $0.08 and 3 cents. So after 10 flips, starting with $1, you have 3 cents, even though the average return per flip was positive 20%.
Wow, okay, that's brutal.
It gets worse. The paper points out even if you have a favorable run over 100 flips, say 55 heads and 45 tails, if you played all in the whole time, you'd end up with something like 4.5 cents for every dollar you started with. A massive loss.
Despite winning more often than losing.
Yes. And here's where it gets really interesting. The expectation that average return suggests huge gains, like 1.2, 100 is, I think it's over 80 million.
80 million versus 4 cents. That's quite a gap.
It's a staggering difference, and it highlights the danger. The paper calls strategies like this parodies of growth investing.
Oh.
You know, things that look amazing for a while, growing exponentially on paper, but carry this inherent risk of just collapsing to zero because one bad hit wipes out so much capital. They warn against following ghosts wholeheartedly into the abyss. It's a warning about focusing only on expected return and ignoring the catastrophic impact of volatility on your entire capital base when you compound.
That all in and ruin reminds me of martingale gambling strategies, like doubling down after every loss at roulette.
Exactly the same principle. The martingale sounds clever. You eventually win back your losses plus 1 unit, right?
Yeah, assuming you have infinite money and no table limits.
Which, of course, you don't. The paper makes this great point. Going all in lets the house play a martingale against you. As an individual, you run out of capital. You might then need to borrow, take on leverage, just to stay in the game. And that's a key difference in the real market. Big companies, banks, they can access massive leverage. They can play these riskier games. When you invest in a leveraged company, even as an equity holder, you're indirectly taking on that risk because the debt holders, the bond holders, they get paid first if things go bad.
So leverage is already baked into some assets, adding another layer of risk we might not see immediately.
Precisely. It complicates the risk analysis significantly.
Okay, so one coin going all in leads to ruin. What if we diversify slightly? The 2 coins game. Split the money, say 50-50 between 2 independent coins. Same rules for each coin. Let's use that same bad sequence for coin 1, HTT, and add another independent one for coin 2, say HTTH.
Okay, run the simulation, splitting the dollar 50-50 each round.
The result, we end up with about 4 cents. Still basically wiped out, only a penny better than the single coin.
Right. The expected value is still 1.2x per dollar bet overall, but ruin is still the most likely outcome. The paper shows even with average luck over 100 flips across 2 coins, you barely make anything. Maybe 1.38 units back for every one you put in.
Still nowhere near that 80 million expectation.
Not even close, which proves that just adding more independent risky assets isn't the magic bullet. It's about how they relate.
So this must lead to the magic coins.
Exactly. The magic coins game. This is the key insight. The rule changes. The 2 coins are now anti-correlated.
Meaning they always land on opposite sides. If one is heads, the other must be tails.
Correct. So let's use our bad sequence for coin 1 again. HTTTTTTTT. Coin 2 automatically does the opposite. THHHHHHH. Now split your money 50-50 each time. Let's track it carefully. Start with $1. Flip 1 HT. Win 0.502, $1 on coin 1. Lose $0.50, much 20 cents on 25. 25 equals $0.20 on coin 2. Total. $1 plus $0.20 equals $1.
Yeah, I mean 20 cents.
Flip 2, TH. Lose these at $0.06, 96 cents, $1.24 on coin 1. Win the $0.60 on coin 2, total cents on 24s, plus $1.24 on coin $1.54.
I mean another 20% on the $1.20.
Keep going. Flip 3, TH, 24 cents, plus $1.288, plus $1.44, $1.728, and so on. If you run the full 10 flips, you end up with about $6.19.
Whoa. From 3 cents in the other games to over $6.
And look what happened each time. You gained exactly 20% of your current capital on every single flip. The outcome is totally deterministic.
No risk at all.
None. By combining 2 individually risky but perfectly anti-correlated assets, you've manufactured a riskless game. This is what the paper connects to Kelly strategies, finding the optimal bet size to maximize long-term growth by managing risk. For you, the listener, this is huge. It shows the real power of diversification isn't just adding stuff, it's adding stuff that behaves differently, ideally negatively correlated, to cancel out risk and create smooth, predictable growth. It's about achieving that coherence.
That's a fantastic illustration. So moving from these simple coin games,
yeah.
How does this map onto, actual financial theory that people use?
Well, these basic principles are actually fundamental to a lot of modern finance, even if that coherence part is sometimes missed. The big starting point is usually Markowitz Modern Portfolio Theory, MPT Nobel Prize stuff. The idea is to build a portfolio that gives you the highest possible expected return for a given level of risk, or, put another way, the lowest risk for a given expected return. It uses the average returns of assets, the paper calls them CSI, and crucially, how they move together, their covariances, rho, ij. Markowitz put this into a specific quadratic formula, and if you assume asset prices follow geometric Brownian motion, kind of a standard model where things drift up but wiggle randomly, then maximizing Markowitz's formula is the same as maximizing the portfolio's long-term median growth rate, which boils down to maximizing HIFS 22.
You mean return minus variance over 2. Okay.
Right. M is the mean, through sigma squared is the variance, or risk. So MPT is trying to find that sweet spot. And this directly quantifies the reward for diversification the paper talks about. They state it quite nicely. In terms of long-term median growth, 1 is stochastically paid for destroying variance at a rate on 1 variance destroyed gives 1/2 unit of median return.
Okay, translate that.
It means reducing the overall wiggle, the variance of your portfolio, by adding assets that don't move together, that actively pays you in the form of a higher, more reliable long-term median return. Diversification isn't passive, it's active risk management that boosts your reliable growth rate.
That makes sense. So how does the famous capital asset pricing model, CAPM, fit into this? Everyone hears about beta.
Right. CAPM is probably the most widely taught model. The formula usually looks like FAR. Let's break that down. Okay. R is your assets expected return. R is the risk-free rate, think treasury bills. R is the market's expected return, like the S&P 500. And beta, that's the key. It measures how sensitive the asset is to overall market movements. Technically, it's covariance with the market divided by the market's variance.
The traditional idea is higher beta means higher risk, so it should mean higher expected return to compensate, right? That's how you supposedly beat the market.
That's the classic interpretation, yes. You take on more market risk, higher beta, to get more return.
And models like Fama French just add more factors like company size or value.
Exactly. They try to explain returns better by adding more dimensions beyond just market beta. But here's the paper's big critique. Classical CAPM completely ignores coherence.
Coherence again. How does that apply here?
They use this great analogy, selecting an outfit. Some items just don't work together, right? A certain accessory might clash, and you have to take something else off for the whole ensemble to make sense, to be coherent.
Okay, I get that. Like the magic coins fitting together perfectly.
Precisely. That harmony, that synergy. CAPM doesn't really capture that internal portfolio dynamic. It mostly looks at how each asset relates to the overall market, not necessarily how assets relate to each other within the portfolio in a deeper way. The paper aims to fix this by dealing with these coherent fragments of the market directly using their topiary index theory.
So that's the link. Simple diversification isn't enough.
Yeah.
The assets need to sort of harmonize, like the outfit or the magic coins.
Exactly. It's about the fit, not just the individual pieces or their relation to the whole market average. This topiarism is about finding that fit.
All right, let's dive into topiarism, that name. Quadratic programs over reproducing kernel Hilbert spaces. It sounds incredibly complex.
It is mathematically sophisticated, no doubt. But the core ideas behind it offer really powerful practical insights into finding these optimal coherent portfolios. It starts with a concept called the maximum principle, often seen in things like heat diffusion. Basically, in many systems, the maximum concentration of something tends to end up on the boundary of the space, not floating in the middle. Think heat on the edge of a plate.
Okay, like the most extreme values are on the edges.
Kind of. It's related to Shilov boundaries in complex analysis. The paper cleverly applies this idea to the portfolio optimization problem. It suggests the best portfolio allocations aren't just anywhere, they lie on a specific edge or frontier.
Got it. So what are the paper's big contributions using this idea?
Okay, there are 3 main theorems that really outline their framework. First, the green topiary theorem. This says optimal portfolios, the really coherent ones, must be built from assets within a potentially very small set, which they call the green frontier. It's like an exclusive club on that boundary where the best solutions live.
So it narrows down where to even look for the optimal assets.
Precisely. Second, and this is maybe the biggest one, the invisible index theorem. This is the bridge between those opposing investment styles we talked about. It suggests that if there's some kind of ideal perfectly diversified platonic index fund out there, maybe hypothetical, like an invisible hand index, then finding the optimal portfolio within any smaller group of assets is really just an attempt to mimic the behavior of that ultimate invisible index.
Wow. So the index fund investor and the focused value investor are both, in different ways, trying to track the same hidden thing.
That's the implication. Your strategy, broad or narrow, is just your particular way of trying to capture the essence of that underlying, possibly invisible, true market index.
Okay, that's a profound idea. What's the third one?
The capital asset pricing inequality. This has direct consequences for how we evaluate stocks. It says that for assets that aren't part of a coherent, optimal portfolio, the inconsistent ones, their performance must be worse than what the standard CAPM predicts.
Worse than CAPM predicts.
They define a topiaric beta based on the asset's relationship to the topiary, the optimal coherent portfolio, not the whole market. The inequality is at X, RK equals X. SX, EPS or XX. The key is, for assets inside the topiary, it's an exact equality. For assets outside, it's strictly less than or equal.
So the alpha, the extra return beyond what CAPM predicts.
For inconsistent assets, that alpha is always 0 or negative. It implies you don't get alpha just by picking good individual stocks. You get it, or rather, avoid negative alpha, by picking stocks that fit together coherently to track that invisible index. It also subtly suggests classical CAPM implicitly assumes the assets already form a topiary.
Okay, so the math behind this, RKHS Hilbert spaces. Can we unpack that without getting totally lost?
Yeah.
Let's try. Think of reproducing kernel Hilbert spaces, RKHS, as like special graph paper for functions. It's a mathematical space where you can draw functions like asset returns over time in a way that makes it really easy to measure how similar they are using an inner product. That inner product is basically their covariance, how they move together. The crucial bit is point evaluation. It means you can reliably pinpoint the value of any function at any specific time, which is obviously vital for finance.
Okay, a structured space for comparing asset movements. What about kernel embedding?
Kernel embedding of distributions is the trick they use to take a whole complex portfolio, maybe hundreds of stocks with different weights, and represent it as just one single point in that nice RKHS space. It maps the messy reality onto this elegant mathematical structure. This is key to explaining sparsity.
Sparsity, meaning optimal portfolios use few assets.
Exactly. Because representing the portfolio as one point relates to finding the outline of a set, kind of like support vector machines, SVMs, in machine learning. SVMs find the best boundary using just a few key data points, support vectors. Similarly, this suggests you can capture the essence of market coherence with potentially just a few well-chosen assets.
So you don't need the whole haystack, just the right strands that define its shape.
That's a great analogy. You need the support vectors of the market's coherence.
All right, so all this math leads to topiarism itself. What are the key components defining this optimization?
At the heart is the aesthetic objective. The formula is FTOR22.
What's complex? What's the intuition?
The paper shows maximizing this is the same as minimizing 2. Think of IS-PCSI as your ideal target performance and EV as your actual portfolio's performance. So maximizing the aesthetic objective is like trying to get your actual portfolio to perfectly match your ideal, minimizing the difference or distance between them. It's about achieving a kind of perfect alignment or harmony.
Okay, like a portfolio perfection score. Then what's the aesthetic margin?
The aesthetic margin, that's AEA. Think of this as a specific score for each individual asset you might include. The crucial insight. For the optimal portfolio, the topiary K, this margin is exactly 0 for every asset included in it. They pass the test perfectly. For any asset not included, the margin has to be negative or 0. It's like a strict quality control only assets that perfectly contribute to the overall harmony get in.
And the topiaric rate?
Topiaric rate, RK, is PAASD. If a risk-free asset is part of your optimal portfolio, this rate actually equals the risk-free rate. It's like the baseline coherent return.
And all this defines the topiaric index, topiaric K.
Exactly. That's the set of assets where the aesthetic margin is precisely 0. That's your coherent core, the optimal selection that achieves the maximum aesthetic objective.
Got it. The chosen few that create the harmony.
Precisely. And this ties into the topiaric Julia-Carey-Theodore inequality.
Another inequality.
Informally, it just says the function for the raw assets is more contractive, or maybe more spread out and less predictable than the function for the optimal portfolio. The optimal portfolio is more disciplined, more constrained, more coherent than the underlying pool of assets.
Can we visualize this? You mentioned figures in the paper.
Yes, figure 1 helps a lot. Imagine a graph. Assets on the topiaric frontier, the optimal ones, lie exactly on a line with slope 1, a red line in the figure. All other assets, brown in the figure, must lie below this line. The line hits the y-axis at the topiaric rate, bar Chierier. It looks a bit like the standard security market line from CAPM, but it's based on coherence with the topiary, not just market beta.
Okay, so it visually separates the in crowd from the out crowd based on coherence.
Right. And figure 2 shows that if some assets lie way off on the axis, it means the topiary, the optimal portfolio, doesn't correlate much with them or the market. This could visually represent things that operate independently, maybe radical innovation, new memes, even fraud things that don't fit the established market coherence and thus lie below that optimal line.
Interesting. So it provides a visual intuition for why some things seem disconnected from the main market trends.
Exactly. It helps visualize how the model distinguishes assets based on their fit within that optimal coherent structure.
Okay, understanding the theory is one thing, but, how do we actually find these optimal portfolios in the real world with messy data and all?
That's the critical question, and the paper tackles it head-on with approximation methods. They discuss ascent methods, which are basically sophisticated forms of gradient ascent, like climbing a hill blindfolded by always stepping in the steepest uphill direction. They provide an update inequality, Theorem 7.3, that mathematically guarantees your aesthetic objective, that portfolio perfection score, improves with each step. You're always moving towards a better solution.
So it's guaranteed to get closer.
Yes. And even better, the topiaric law of large numbers, Theorem 7.4, gives convergence rates. It shows the objective function converges reliably towards the optimum, at worst like O1n, and the portfolio allocation itself converges to maybe O1n 14 or even faster. This is huge. It means these methods work reliably and predictably, which is essential for practical use.
That's reassuring. Are there more, practical algorithms?
Yes, they discuss greedy constructions. These build the portfolio step by step. One is called greed. You start somewhere, maybe with one asset. Then you keep adding the one asset that gives you the biggest boost in aesthetic margin right now. The idea is this process should lead you to a portfolio whose assets are all on that optimal green frontier.
Just keep adding the best next piece.
Sort of. But then there's Screeden, which is smarter. It not only adds the best asset, but it also removes assets that are no longer contributing optimally as the portfolio evolves.
So it cleans up after itself. Why is that important?
It avoids the chronic zigzag drag problem. Imagine you start with a bad initial guess. If you only add things, you might keep adding assets that aren't really part of the true optimal set just because they looked good temporarily. You end up zigzagging inefficiently towards the solution.
Like trying to pack a suitcase by just stuffing more things in without rearranging.
Exactly. Figure 3 shows this beautifully. Screeden, by both adding and removing, takes a much more direct path to the optimal, coherent portfolio.
Okay, makes sense. What about other approaches, algebraic?
They touch on that, especially for finite sets of assets. The discussion theorem, Theorem 7.8, basically says if your current portfolio has an asset X that could improve things, it has a positive aesthetic margin, there's a way to bring X in and make the portfolio better. The suggested algorithm involves adding X and adjusting others.
Sounds straightforward.
Well, there's a catch. They warn about potential co-fights, borrowing a term from the game Go.
Co-fights, like an endless back and forth.
Exactly. You might find yourself in a loop. Add asset X to remove asset Y, but then you need to add Y back to remove X, and you get stuck, making no real progress. This is why those greedy algorithms, especially Screeden with its cleanup step and proven convergence, are often more practical. They avoid getting stuck in these cycles.
Got it. So once we find an optimal portfolio, what can we say about its structure? You mentioned post-hoc and no backtracking presentations.
Right. This is about understanding the architecture of the optimal solution. Finite accessibility, Theorem 7.9, is fascinating. It says if you have a finite optimal portfolio, a topiary index, you can always remove one asset, and what's left is still an optimal portfolio just for a smaller set of initial possibilities. It implies a nested structure.
Like Russian dolls of optimal portfolios.
Kind of, and that leads directly to finitary no-removal constructibility, Corollary 7.0. This is really cool. It means you can actually build up an optimal portfolio one piece at a time in a specific predetermined order without ever having to remove an asset you've already added. Each step creates an optimal subportfolio.
So what does this all mean? It sounds like the optimal portfolio isn't random, but has this inherent logical structure, almost like it was meant to be built that way.
That's the feeling, yes. Predetermined and expedient to be understood. Figure 8 even shows this for divestment, dismantling an optimal structure piece by piece, maintaining optimality at each stage.
Are there limits to this? Open questions.
Definitely. The paper raises two big ones. Problem 1. Does this no removal construction work for infinite sets of assets? A topiaric branch, we don't know for sure. Problem 2, the broad index problem. Given a bunch of assets, how do you find the largest possible coherent topiaric index within that set? These are important because they relate to real-world messiness. Why do models sometimes fail? Often because of outliers that don't fit. Finding large, robustly coherent portfolios is key, even if they aren't the absolute mathematical optimum. It's about practical resilience.
Okay, this is where things get really wild, right?
Yeah.
Applying these financial math ideas to mazes and organizations.
Yeah, this really shows the universality of the principles. Let's start with the Minotaur in the hedge maze. It sounds whimsical, but it's a serious mathematical application. Using a specific setup, real Fox space, setting 0, they show that following the gradient of the aesthetic objective can trace a path through a maze, represented by a set M, without hitting the walls.
So the math naturally finds a way through.
Yes, and if the maze boundary is mathematically smooth, the optimal path, the topiary, is actually finite, a specific set of steps. Even cooler, the 0 contour of the aesthetic objective touches the maze walls exactly at the points defining this optimal path. It acts just like an SVM finding the boundary.
Where the math feels its way along the edge.
Exactly. And if the maze winds around the origin, the solution relates directly back to the invisible index theorem. They even mention recursively defined mazes could encode universal computers. The analogy for markets is, maybe, without shocks, markets diffuse naturally, and stocks act like flux gatherers, settling into optimal configurations.
That's so different from normal maze solvers that need walls, like insulation, to guide the path. Here, the path just emerges, like the invisible hand caught in the cookie jar, as they say.
It implies these inherent value flows in complex systems, linking to control theory ideas. Figure 5 shows these paths emerging naturally. It's quite beautiful.
So how does this generalize beyond mazes?
They propose a trichotomy of topiary behavior, using the maze idea as a caricature for investing styles based on the nature of the asset set M1. If M winds around the origin, broad possibility, the topiary looks like a broad index fund, capture the whole system. 2, if M is like picking points off the boundary, this is a deep research, careful stock selection, value investing. 3, if the origin is in M, risk-free asset available, maybe just buying an index fund is optimal.
But the invisible index theorem ties these together.
Yes. The crucial point is that in light of that theorem, all these strategies are just different ways of approximating that same underlying invisible true index. Differences come down to salience, what's visible or accessible to you.
Okay, bringing it back to finance directly. Topiaric portfoliation.
Right. This applies directly to maximizing that median growth rate. A key practical finding. If a risk-free asset exists, the assets with the highest average return must be on the green frontier. This helps avoid that inefficient zigzagging search. Their hedge corresponds to the Markowitz portfolio.
What about constructing these portfolios?
A really important point. Optimal portfolios with non-negative weights, meaning you only buy, no shorting tend to be sparse, supported on small sets of assets.
So simpler portfolios are often better if you don't short.
Often, yes. Portfolios with arbitrary weights, allowing shorts, tend to be diffuse, spread out. This sparsity makes the greedy computation much easier and more robust in practice. This also helps with a big problem in traditional MPT. Real-world covariance matrices are often noisy and ill-conditioned, making the true Markowitz optimum hard to find reliably.
How does this handle outliers?
It suggests adjusting the mean or variance directly for lucky or unlucky data, which is different from just tweaking risk tolerance like in Markowitz. They really stress the benefit of using positive convex combinations, just buying, no shorts or margin. It avoids extrapolation errors and hidden problems, performs reasonably fast, and converges well.
Does the optimal portfolio ever change?
Absolutely. And this is critical. The topiary changes if your return covariance methods change, or even if you just change the currency you're measuring in. This implies, as they say, certain mutualism exists due to uneven opportunity, resolution, or information. Optimal isn't fixed. It depends on the context, the information, the observer.
Which raises an important question. If the optimal frontier is sparse,
it implies the game is massively multiplayer. There isn't just one optimal point. There are likely many competitive locations or coherent strategies coexisting. Figure 6 gives a visual sense of this with real stock data.
And this applies even to organizational structure.
Surprisingly, yes. Think of resource allocation problems in any organization. They commit resources to uncertain things, right? Foraging for opportunities. They need to decide where not to look. That going well together outfit analogy works perfectly. Which parts of a business can thrive independently?
How does structure play into it?
Figure 7 suggests lateral suborganizations like self-contained units handling a whole product line might be more resilient than traditional functional silos, just manufacturing, just advertising. Why? Because they inherently diversify risk within the larger organization's structure. They piggyback off the risk reduction.
And figure 8, the divestment paths.
It shows that no removal constructability applies here too. You can, in theory, dismantle a coherent business structure piece by piece, maintaining optimality, though overall fitness might drop. It provides a logical path for restructuring.
Why don't businesses diversify more then?
Because, unlike liquid stocks, businesses face huge reallocation costs. Shifting resources, closing divisions, merging. It's slow, expensive, disruptive. They can get stuck in structures that aren't easily changed. Even if diversification is theoretically better, the cost of achieving new coherence is high.
Finally, how does this connect to the adaptive market hypothesis?
Andrew Lowe's idea is that markets aren't perfectly efficient or irrational, but constantly adapting ecosystems. The paper frames optimization in this light. Maximize IP22. Here is your present allocation, and IPSR is your past allocation.
So you're optimizing relative to your history.
Essentially, yes. You're balancing return and determinacy while also considering the distance from your past strategy. The expectation is that current strategies, similar to successful past strategies, perhaps combinations of past successes, will perform similarly.
So it's a dynamic view, learning from the past to adapt the present.
Exactly. For you, the listener, it suggests that understanding market history and past successful allocations, viewed through this lens, can guide current strategy in a truly adaptive way. It's about evolving, not just reacting.
Wow. Okay, after all that, what's the single biggest takeaway, the main aha moment from this deep dive?
For me, it's that beautiful reconciliation of the broad versus focused investment debate. The invisible index theorem suggesting they're both chasing the same underlying coherent truth. That's really powerful.
Yeah, that they aren't fundamentally opposed, just different approximations.
Right. And the practical implications are huge. We've seen why real diversification, that coherence, matters so much. Why going all in is so dangerous despite appealing averages. And how this idea of coherence, mathematically defined, gives us tools for better decisions in finance, yes, but even in thinking about how organizations should be structured, it gives a rigorous why behind strategies that work or fail.
So the final thought I want to leave everyone with is this. If our best choices, whether in investing or building organizations, are fundamentally about approximating some invisible index or finding that coherent green frontier, how does knowing that change how you approach your own decisions? Realizing that maybe optimality isn't about picking the flashiest individual performer or just spreading bets thin, but about seeking that deeper understanding of how things truly need to fit together within the whole system to create resilience and lasting value. Something to definitely mull over.